Mayuresh Joshi joins us. Let's take a conversation forward. Mayuresh, the question which we are debating, deliberating, and discussing is that do we have a durable trading bottom in place for the market now? And it will take a lot of global bad news or local events to break that recent low.
Afternoon, Nikunj. I think we have been analyzing a lot of aspects, including how the gap between the bond yields and the earnings yield have probably panned out over the last 10 to 15 years. And in terms of this narrowing of spreads, we are below the long-term averages. So to a certain extent, the market is trying to pencil in that earnings should start reviving at some point of time as we head into the first half, both as a combination of better monsoons aiding rural recovery and consumption's improving because of the tax cuts that we've probably seen. So base case scenario getting worked out that the first half of the next financial year, earnings should start bottoming out, reflecting in probably the spread narrowing as well. The second aspect obviously has been in terms of the previous and the past corrections as well. And the periodicity of this correction, obviously, I think from oversold zones, we've probably come back to a large extent. But to a large extent as well, I think all the previous falls that we've probably seen, the kind of battering that has happened across the small and mid-cap space, I think the kind of fall that we've probably seen in terms of price damage, selectively, I think a few pockets within the mid-cap universe have started probably looking attractive. And last but not the least, I think in expectations of Trump tariffs and tantrums as well, what probably happens in terms of global economy, global inflation, core inflation itself, and the interest rate cycle, I think the markets have penciled the worst probably in. And therefore, I think within the emerging pack, India's earnings should start bottoming out. Indian macros probably better than the rest of the emerging economies. And therefore, I think India should do well. But the bottom is in place. But it probably looks like a large part of the price damage has already been gestated by now.
The other group which is suddenly looking strong, Naresh, are some of these Adani group of stocks. I can see them, they are coming. I mean, they are not roaring. They are not going tom-tom. They are not going crazy. But from the recent lows, which is, let's say, an Adani Enterprises, Adani Green, Adani Energy, Adani Ports, they're showing signs of life. Naresh, is there a trade in any of the Adani group of stocks?
So most of these names have started making a similar bottom. So one which comes clearly is Adani Ports. Almost four bottoms around 1050. 1160, 1180 has been the top for the last almost 3 months multiple times. If it sustains above those levels, looks interesting. Similarly, Adani Enterprises itself has met the same bottom around 2050, which was the low in November. Also, roughly, this was the low back in November of last year as well. And this is where there was a big base also in 2023 after the fall. So if that starts sustaining about 2300 levels, that could be interesting as well. So Adani Enterprises and Adani Ports is what could be tradable out of the whole segment.
That's about the Adani group of companies. In fact, let's stay with that theme because Macquarie as well as Cantor both have come out with their initiation note where they initiated coverage on Adani Green. My colleague Varun is here to tell us exactly what both the brokerages have to say on this company. Varun, over to you.
Well, brokerage houses are turning bullish on Adani Green. Macquarie and Cantor both have initiated coverage on Adani Green with a good outperform rating. Let me start with Macquarie first. They have initiated coverage with an outperform rating and a price target of 1200. They say that India plans to triple its overall renewable energy capacity till FY30 and Adani Green is going to play a leading role in the transition of Indian energy sector with a capacity of 50 gigawatt by around 2030 from 12 gigawatt currently. So this implies a CAGR growth of around 25% in the next coming 5 years. Also, they expect the company to generate around $1.8 billion of annual operating cash flow against a cumulative capex of around $10 billion till 2030. Despite this heavy capex, the net debt to equity for Adani Green will reduce from 7 currently to around 5 times till FY30. And also they say that the valuations are attractive. Now, Cantor has initiated coverage with an overweight rating and a price target of 1222. They say that the growth for this company has just started and there are several tailwinds for the company that will help in the overall growth. They expect the capacity to increase 4 times in the next 5 years, and from FY25 to FY30, they forecast the revenue and EBITDA to grow at around 21 to 26% CAGR in the next coming 5 years. Also, they say that the valuations are attractive. The stock currently trades at around 15.6 times FY26 EV by EBITDA which is actually lower than what its peers actually command. So valuations are attractive and the overall growth story for this company is very good, and that's the reason Cantor and also Macquarie have initiated coverage on Adani Green with a price target of over 1200.
All right, moving on to an exclusive now. The government is planning to give a fresh push to promote domestic manufacturing of solar equipment and has revised norms regarding the use of solar PV cells. So what is government trying to do? Well, India is abundant in hydrocarbon. No. India is abundant in solar, which means that the raw material for energy is solar that is available for free. We are not self-sufficient in hydrocarbon. Hydrocarbon is fossil fuel, which means India is trying to now ensure that our global dependence on oil, which is a source of energy for us, goes down, and our dependence on solar becoming prominent is high. How is solar generated? How is solar power generated? I mean, if you're traveling next time, just look up and there are a lot of rooftops have these solar modules. Those solar modules are actually the source of solar energy. I'm really making it simple so that our viewers can understand it, right? Pardon me if you know it, but I'm still trying to make it simple. China is like the good place where all solar manufacturing is done. And in China also, today the cost of making solar modules is cheaper than India. But government of India, in order to promote the industry and promote innovation and ensure that we just don't stop at solar modules, we go to cells, we move to wafers, we move to ingot, and we move to battery, they're trying to protect the domestic industry. The government cannot force a private player to buy, but they can certainly come with an intention where they can promote government projects to be fired or to be backed by local manufactured modules. And Prakash is standing literally in the sun and he's doing a solar story. So Prakash, you there? So Prakash, I mean, that is the spirit I like, right? You're doing a story on solar and you're standing in the hot sun in Delhi and doing it.
The government is providing a fresh push to promote domestic manufacturing of solar equipments. In fact, a strategy has been put in place to encourage domestic manufacturing of solar PV cells to meet domestic requirement, which is likely to cross 60 gigawatt by 2027. And therefore, several steps have been taken by the government. Ministry of New and Renewable Energy has revised norms for using solar PV cells in renewable energy projects. In fact, norms have been revised to mandate use of domestically manufactured solar PV cells in government's flagship schemes. Ministry of New and Renewable Energy has classified certain category of silicon wafers being used as a raw material for manufacturing of solar PV cells as a domestically manufactured solar PV cells. A very significant development coming in. Classification will, of course, provide clarity to the domestic manufacturers. An official order has been issued by the Ministry of New and Renewable Energy. It has been informed to the manufacturers enlisted in ALMM list. Along with that, NBFCs such as SECI and IREDA have also been informed by the government.
All right, thank you so much for that, Prakash, for giving us this exclusive story that the government is planning a fresh push in order to actually promote the domestic manufacturing of solar equipment. We have a couple of them that are listed entities that we need to watch out for those, whether they stand to benefit from this one or no. But coming to you, Mayuresh, I want to understand your your view, especially on this entire theme, the renewable energy theme, the fact that the government push and the impetus is on that particular domain out and out. What's your take on that, and which stock do you like in that space, if you do, that is?
So two aspects, I think. The intent of the government is obviously there because they need to get the renewable capacity to 500 gigawatts over the next few years, and a large addition of that will be solar. But I think hydro and hydel plants, specifically small hydro plants, might do exceptionally well, in my opinion, again, in specific areas of operation itself. And therefore, a lot of the equipment manufacturers or the EPC players for either solar or hydro or renewable as a space might actually do well. The second part of the equation is also the flue gas desulfurization players. Because as we head over the next few years, and the deadline has obviously been extended till March 26, maybe it gets extended 1 year more. But that's a 1 lakh crore market out there. Only 10,000 crores worth orders have been metered out. Very few players that can actually make this equipment so that the existing thermal plants don't pollute. And therefore, looking at the climate emission norms, I think this segment of the market, along with renewables, specifically the small hydro that I was talking about, can actually do well. So within the FDG players, I think players like a Techno Electric, as an example, has a good mix in terms of FGD equipment, smart meters, and therefore they are in the right spaces as far as government capex layouts is concerned. Obviously, I think with the correction that we've probably seen, would like them to make good sound bases. But I think these two spaces might actually do well as far as energy as a space is concerned over the next 3 to 4 years.
Mayuresh, there's a debate which says that everything which moves on wheels will be electric. There's a debate which says that everything in future will not be EV. Maruti is saying that I will do hybrid. Mahindra is saying that I will still roll out EV. Who will be the winner in this entire EV space? I mean, there was once upon a time we thought Ola is the ultimate EV company. Today it's gone to 45 rupees. There are so much of yes, no, I don't know in the entire auto EV space. Who will be the winner?
So, Nikunj, honestly, I think over the next few years, electric will dominate. At what time periodicity, I think very difficult to say. I was going through a global auto report, which is probably seeing signs of stagnation probably happening, even as far as the electric market is concerned, whether it's Europe or even North America to a large extent. And therefore, the adoption, obviously, with respect to pricing, with respect to infrastructure, largely related to charging of these vehicles, and the changes that happen in terms of both batteries as well as the powertrains, as far as electric vehicle platforms are concerned, are going to be very, very evolving. So I think the kind of R&D spends that have been done and are being done, I think there will be significant amount of incremental capex that will keep on as technologies evolve. Having said that, I think specifically for a market like India, I think we're still evolving as a space. And like power, where we're not directly going to go into renewables over the next few years, thermal will still stay put. Even for automobiles, I think the electric engines will obviously take precedence over the next few years, but that will be restricted to certain urban pockets. In semi-urban and rural areas, I think it will still be the internal combustion engines, the petrol and diesel cars that we are talking about, the hybrids that will come to the fore. And therefore, I think a stock like Maruti, just as an example, which probably has a clear-cut advantage, both in terms of creating hybrids, in terms of electrical mobility platforms as well, and the internal combustion engines with very, very attractive price points, the dealership network that they've got, the service stations that they've got, and after-sales service as well, might actually benefit in the Indian ecosystem. So whether Tesla comes in, I think certain urban pockets might do well, or the M&M launches that you've probably seen. But consistency over a longer period of time, I think Maruti has the right mix, in my opinion, to cater to all these segments over the next few years.
11560. Anybody wants to guess what was Maruti's price when it went public? Who wants to guess? Mayuresh, I think, knows the answer. No, Kunal? It went public in July 2004. Let's check. Little bit of Google. Let's see who beats.
It's like fastest finger first who was
125,
able to
July
land.
2003.
2003.
2003.
Yeah.
2003. June or July?
July.
July, yeah. I mean, that much I don't remember. 125 rupees.
Yes.
125 rupees, guys. 125 rupees is when Maruti went public. It was India's number one car company then, and it is India's number one car company today. The point I'm trying to say is that the leader always remains leader. And looking at Nuresh's expression, he does not own Maruti. Otherwise, he would have laughed if you bought at 125, right? Nuresh?
Bidding in the markets back then, sir.
Just think about it, guys. Just think about it. You know how a simple business which is built around efficient car, affordability, moving up the value chain, efficiency, ups and downs have come. COVID has happened, demon has happened. There have been issues about their inability to move into EV. There have been issues around they've been selling a lot in terms of royalty. That's another great company. Second great company which we met, I think 10 days ago, was Jubilant FoodWorks, another great company. I think it went public in 2008. 2008? 2009, I think. 2008, I think went public. It was...
Yeah.
2009 it went public. And you add back the bonuses, you add back what has happened to the stock, I think it's all like a 20x. 2009. They sell 40 crore pizzas a year. 40 crore pizzas a year is what they sell. And there you go, 2, 4, 5, 6. So it is 24 times. Mayuresh Joshi, you never told our viewers to buy Jubilant Foodworks. Why it is that you never told our viewers to buy Jubilant Foodworks? Just buy a pizza company and keep it. 24 times in what? 15 years? 24 times.
I think there have been phenomenal moves, Nikunj. I think no two ways about it. But I think the important crux now here is that the changes are happening very, very fast and are evolving very, very fast as well. So I think the modes of delivery are also going to be very, very important as far as a lot of these consumer chains, stroke consumer discretionary products are concerned.
Bit of a choke there. Never mind. So, Kunal, today we'll not talk about today, tomorrow. Tell us one stock which you think I will keep it for 5 years. Doesn't matter what tariffs are, doesn't matter who the Prime Minister of, who the President of America is and what he has to say. I will buy the stock for 5 years. Which is that one stock?
So there are two charts which are looking attractive in that sense. One of them is a mid-cap name. It's something which I've been tracking over the last few weeks. Hikal. That's a stock which I think is around 370, 380. Yeah,
it's run into rough weather because of a family dispute.
Yeah,
so that's
on the chart, which is looking very attractive. And the second one is which again very recently has been on the news flow. That's Castrol. That's around 230 to 235 thereabouts. That's also another thing which is looking.
It is looking good for 5 years.
Yeah, for 5 years, long-term charts.
Mayuresh, you love to do that analysis, right? I mean, look at bear market survivors, look at stocks which have not trended. Which are two stocks you like to buy for 5 years? And Mayuresh Joshi, I'm coming right to you. So please get that list ready. But it is Mayuresh first.
So I'll go with a name which I like right now as a survivor is KRBL. That's a stock which has been at the same price for 10 years. I hold the stocks for standard disclosure here. The stock is available at the lowest valuations, the same price as 10 years back, and a non-disruptive business, available cheap, and the stock has been consolidating sideways for the last almost 1 year as well. So 1 year, 5 years, 10 years, gone nowhere. But this could be a stock where downside is limited, but could be a surprise over the next 5 years.
Mayuresh Joshi, your two stocks for minimum 5 years, but the condition is that it should be at least 3 to 4x in 5 years. That's a reasonable time frame, right?
Sure. I think I'll hazard a guess here, Nikunj. So I think Kotak Bank, out of the large names, our take is that there should be decent growth that probably happens as far as banks and financial institutions are concerned. And in our own estimates, Kotak can actually deliver significantly as far as most parameters that banks normally do. So whether it's advances growth, reasonable amount of deposit growth, stable NIMs, asset quality and credit underwriting should be top notch. And again, I think in terms of the return ratios should be right there at par with the best banks in the world. So our own sense is that Kotak might actually deliver phenomenal numbers over the next few quarters and years. That's the large cap name that we probably like in terms of ratings and rankings. Out of the mid cap space, I think Welspun Corporation is something that we continue to like over a longer period of time. I think two reasons out here. One, I think in terms of the core business itself, they are among the top three globally as far as the line diameter pipes are concerned. The kind of capex that will go in, whether it's North America, whether it's the Middle East, or whether it's India specifically for oil and gas, whether it's for sewage treatment, or whether it's for water, I think a large part of the capex is going to continue over the next 3 to 4 years. And therefore, the incremental order book that they probably set out at around 15,000 crores should keep on improving in every passing quarter. Again, the margins and I think that should show significant amount of operating leverage. And therefore, with the opportunities coming their way and the operating leverage that it probably create, the return ratios should be significantly higher every passing year. So our sense is that macros and micros, both locally and globally, should probably support Welspun.
So point taken, those are some of the counters that are looking attractive for the next 5 years, according to Mayuresh. But thank you so much, Mayuresh, for joining us on the show and giving us, sharing those topics of yours, as well as talking about the markets.